Luke McLaren here with the McLaren Real Estate Team, the real estate company here in Calgary. Just like to welcome you back to part 2 of our Real Insight series on mortgages. And I'd like to welcome back Stewart Douglas, mortgage specialist with Scotiabank. He's been giving us some great information in part 1. If you haven't seen part 1, I'd strongly encourage you to go check it out. It's got some great information, insights on when you're first getting a mortgage. And now we're going to get into a couple other topics, a little bit more in depth, to try and help you navigate what's become a very complicated process in this day and age.
It's much different than it used to be. It's not the old days of shaking a hand or using pen and paper, that's for sure.
Yeah, got that right. So the next topic we're going to hit on is conventional mortgages versus high ratio mortgages. So we hear about companies like CMHC, Genworth, Canada Guarantee, who do high ratio financing if you're putting a lower amount down. So Stu, if you could just explain for our viewers, what is the primary difference? What makes something a conventional mortgage versus a high ratio mortgage? In general terms.
In general terms. You know, what people are talking about when you're high ratio versus a conventional mortgage is the amount of down payment you're putting down. How much equity you're putting into the purchase of this home yourself versus having it financed by the bank. And in most scenarios, the magic number is 20%. If you have 20% or more down payment, you should be able to get qualified for a conventional mortgage,
okay.
Provided everything else falls in line, obviously. If you have less than 20%, then you're going to be looking at what's called a high ratio mortgage, which needs to be insured.
Okay. And what's the lowest down payment somebody can make?
Well, depending on the type of property you're buying, if you're buying a primary home for yourself or a secondary home, you can go as low as 5% for down payment. Again, in that case, it would be a high ratio insured mortgage. So
if the mortgage is 5%, so anywhere between basically 5 and 20%, it's high ratio. We have to buy insurance, which is provided by one of those 3 companies we mentioned. So is that expensive? Like, what is the cost involved with a high ratio mortgage?
Great question. So how that works is, that's not a cost, first of all, that comes out of pocket for anybody. The institution actually pays that fee for you, and then they add it onto the mortgage so that you're paying it over the life of the mortgage. Which is nice because instead of having to come up with a few $1,000s or whatever that's going to cost you, it's costing you $10, $15 on your mortgage. It works out to be a much lower payment. What does that cost you? That fee ranges depending on how much you're putting down, what the situation looks like, but roughly speaking, you're typically going to fall between 2.8 and 4% on the amount that you're borrowing that they will charge you the fee.
So let's say 2.8 to 4. So let's say in round terms 3 to 4%. So if someone's buying a $400,000, if they got a $400,000 mortgage, they're going to pay anywhere between $12,000 and $16,000 in insurance premium.
Roughly speaking, yeah.
That gets added to the mortgage.
Yeah, and it's good for people to know that and to talk about it. And I always try to make sure people are aware fully what it's going to look like before we get past the pre-approval process. When they come to me for a pre-approval, and that's because I don't want you putting up 10% worth of down payment and then realizing you don't automatically have 10% worth of equity because we've had to add in that insurer premium.
Right. Okay.
So just to make sure there's no surprises.
Okay. Great. Okay. Next question. So let's say there's some folks out there. They own a home. They want to sell their home, buy a new home, and they're wondering, okay, so how do I do that? How do I make that work financially? So do I have to sell my home and get all my money and then go buy the new home, or is there some way to make a smoother process so I'm not homeless for a while? So what options do people have who are selling and then buying to make that transition as smooth as possible so they're not left homeless?
So more or less what you're asking me, if I'm correct, is that if people have equity in the house that they're selling and they need that equity for the purchase of their home?
Yeah, correct.
So in those scenarios, like I think it's important to sit down and talk to the person you're dealing with and be comfortable that they're looking out for your best interest. But we have different things in place. If you've sold your home and you're going to have a firm sale of your home, and the possession dates on the purchase and the sale are fairly close within each other, if needed, we can do what's called bridge financing, and that allows you to bring up a portion of your proceeds that are going to come to you, allows you to borrow that and bring it up to your possession date, so you have that money for your possession on the new property.
So for an example, I'm selling my house on my house. I've sold my house. It closes May 15th. But I bought a new house, and I want it to close before May 15th because I want time to move in, to transition. So let's say the house I bought closes April 30th, but the house I'm selling doesn't close until May 15th, a couple weeks later. That's the interim period where you're saying bridge financing would be one option.
One option.
What would be some other options?
Absolutely. Well, it depends on your scenario, but I always try and look for ways to work around that if possible.
And why would you want to work around that?
Well, I'm cheap, and
Okay.
so I like to try and pass that along to everybody that I work with. If I can save you a buck, I think it's important. There's going to be scenarios where, for example, we have a product, it's collateral mortgage, where you might have some equity already built into the home that you're selling, and if you don't need all the money from the house that you're selling, you may want to just try and borrow that money. And if there's options set up, you might set up a line of credit or something against your home. Just depends on each scenario, and that just comes in with a much lower interest rate. The reality is, bridge financing is typically for very short-term periods, and I consider it to be very cheap money.
Okay.
But if I can find a cheaper way to do it,
You'll do it.
that's what I'm going to look for.
Okay.
And in some cases, if the numbers work, it may be more beneficial to use an unsecured line of credit than do bridge financing. It just depends on interest rates and considering the big picture when you go through the process.
So that's why it's important to have someone who's well versed in your business, can show them the different options and the cost of the different options, because that's obviously a big one.
I think it's important to have someone that's passionate, no different than your job,
Yeah.
right? The more passionate someone is, the more likely they're going to be there to serve your best interest.
Okay, so kind of along the same line, and you mentioned it earlier in our discussion, what does it mean to port a mortgage? So what exactly is porting a mortgage, and what does that look like?
Another great question. So porting a mortgage to me is a huge part of a mortgage, and today they're coming out, including Scotiabank. We have our own products that they're called non-portable. What does that mean? Porting a mortgage, basically what it means is that you've sold your home, you have a firm possession date of your home, and again, there's restrictions on possession dates, so be careful. And you're buying a new one. And if you break a mortgage, for those that don't know, if you break a mortgage, the majority of mortgages out there, you're going to pay some sort of payout penalty on that mortgage. So porting a mortgage, what that means is that we're basically going to replicate the mortgage on your existing house and allow you to have the same terms and conditions of that mortgage for the remaining life of that mortgage to your new property,
Okay.
in some form or fashion. And what's the benefit of that, you asked? The benefit of that is twofold, in my opinion. One, you're usually porting a mortgage because the rate's very attractive, or you're porting the mortgage because the penalty does not make sense to not port that mortgage.
Okay.
So this can save you thousands of dollars, and I think it's important to look at your options and make sure you have those options.
Okay.
And in line with the porting the mortgage, which you and I had talked about earlier, is that if you're porting a mortgage and you need additional funds above what you have currently on that mortgage, there's different ways it can be done. The way that we do it is we just do another mortgage, so you don't have to put two mortgages for any of the additional money that you would need.
Okay, so you would just add funds to the existing mortgage, and it would all be like one.
Well, no, that's not correct. You end up with two mortgages, but they can set them up so they feel like one to you.
Right.
Eventually, you can, if you set it up properly, you're going to be able to roll them into one. But your new mortgage would just be at the current rates at that point.
Right, so it's not like a second mortgage where I'm paying 8 or 9%.
Correct.
It is a separate mortgage, but it's under the same terms and
It's
conditions.
all under the same window. When we talk
Right.
about a collateral mortgage, it's basically like an umbrella, and it will follow under that umbrella. So you're correct. A lot of people, when they hear second mortgage, they think those higher
Yeah.
8 to 10%
Yeah.
interest
Yeah.
rates. No, the second component of this mortgage, probably a better way to word it, it's a second component of a collateral mortgage, and that would be structured, and the rates would be at today's, the rates at that day.
Okay.
So, yeah, I'm a big fan of porting your mortgage. It doesn't always make sense to port your mortgage. The majority of times I find it does. Not hard to figure out if porting's the thing to do. But that is another thing to be very careful about when you're signing for a mortgage. Know if your mortgage is portable or not.
Okay, and another important point in dealing with clients is sometimes they assume because they have a mortgage, they can automatically port it. But do they have to still qualify, even if they have the existing mortgage? Do they still have to qualify even to port it?
Absolutely, and that's a great question. I run into that all the time. Yes, it doesn't matter what property you're buying. You always have to go through a full approval process. Just because you have a mortgage, they won't take it to a new one. As we had spoken about in your previous segment, they have mortgages are dependent on various things, and these will be property specific, or it's going to be property specific, documentation specific at that point in time. So lots of things can change, a lot of things can come to play. I do recommend you sit down with somebody to get a pre-approval, understand the porting process, make sure you're clear on everything before you move forward. And just to touch base, we talked about adding additional funds. If people are downgrading, you can do a port with decreased funds as well, and then you just would pay the penalty on the proportionate amount of the mortgage that you're not taking. So
Okay.
if you have a mortgage for $500,000 and you're only taking $450, you're going to pay a 10% penalty.
Okay. So really the bottom line here is that it doesn't matter what the issue is. You need to find a specialist, an expert in the field, and you need to go through these things in details, because in the end, if you do your due diligence, it's only going to make your process smoother and potentially save you thousands of dollars.
Correct. It's just like, the way, I talk about the partnerships the way you do as well. And what I say to people is, ask people if they have a realtor or who they're working with. And I stress the fact that it's very important to have a realtor who's well-rounded. They can negotiate. They're going to make sure that they're doing their background checks. They're looking into everything. I think the same thing applies in every aspect of this, including the clients. Everyone's got to work together. Everyone's got to do your due diligence, because, as we all know, your mortgage, your house is going to be the most expensive thing you're going to buy in your lifetime, and you can lose thousands of dollars. So if you have the right people looking at it and you understand the process, you can save a lot of money.
Yeah, right on. Okay, we'll wrap this up with this final question. This is another one that happens quite a bit with our clients. Is someone's looking for a home, they want to try and add value to the property they're purchasing. So they may be looking at homes that need some rentals. They don't mind doing some work. Some people don't mind doing a little, some people don't mind doing a lot. So we're talking about getting a mortgage, which would also include funds for renovating the property. So I want to mortgage my purchase, but I also want to mortgage my renos. So can you explain, do you have products for that? How does that work?
We do. We have for us, it's called Purchase Plus Improvements. A few things that you need to be aware of in those scenarios. First and foremost, when you're doing a Purchase Plus Improvement scenario, we're going to have a look at the property as it stands right now. We call that as is, and then we're going to look at as completed, so when the renovations are done. And in order to do that, you got to move quickly. So you have to have your quotes and everything available for us for when we're putting in the application, to make sure, because we can give you an approval without those quotes, and then you might waive your conditions, and then we find out you don't qualify for.
So in other words, when we're making an offer on a property, we're going for the house for the mortgage, those quotes need to be in place for that initial approval process.
Correct.
Yeah.
It's
So
something
having
to
a
keep in
contractor
mind.
lined up, or if you're doing it yourself, knowing what your costs are, that has to be detailed out, because the lender's gonna wanna see that before they're ever gonna consider
Correct.
that loan.
Okay. So the next part that people are going to need to be aware of in those scenarios is that we don't actually give you the money and say, okay, now go and do the work. That's just not how it works. We want to see that you've done the work, then we're going to give you the money. So what we do is we give you enough funds to close on the property on your possession date. But then somebody has to carry the expense to get some of the work done before we're going to advance any money. So to give you another example, let's say you bought that place for $500,000 or $450,000, and you're going to do a $50,000 reno, so you're going to end up being at $500,000. You want to come to us with the quotes. We're going to go in and get you an approval. Now, if we get your approval, you're going to be qualified for up to 3 draws. Could be up to 4 depending on the scenario, but up to 3 draws to do that work and get everything completed. You're going to need to either have something arranged where you have the funds, maybe you have a line of credit, maybe you talk to the contractor and they're going to carry it. That's going to get you to a certain point in your renovations, and then you're going to tell us we need an inspection. Someone will come and inspect it. They will advance the amount of money that you should be getting. Then you can continue on. So it's effective in that ultimately, instead of having to carry this money on a line of credit or some other way, you're going to be able to wrap that up into a mortgage, have a low interest rate, and you also don't need to have the entire funds to do the renovation readily available. You need to have portions of it.
Okay, so let's take your example. We're paying $450 for the house. We have $50,000 renovations. It's agreed that we get the $500,000 loan. But that $50,000, you're not just giving us. What you're saying is, if there's 3 draws, like you said 3 or 4, let's take 3 draws, so roughly 33%. So that means we have to spend the initial 33%, which for argument's sake, let's say is $17,000 out of our pocket first. Call for an inspection. You do the inspection. If everything looks good and we've done that much work, you'll give us the initial draw of $17,000. Then the next third. Then the next third. So we will get all $50,000, but somehow we have to come up with that initial third and get the work done before you'll start to draw down in that $50,000.
Correct.
Okay.
Yeah, that's well put.
And so the way you're saying this could potentially be handled is maybe there's a way that you could set up a line of credit, or depending on your contractor, if your contractor sees that in fact you have this mortgage in place, it's to do these renos, they might be willing to carry that initial portion to get you through. So again, this is something you need to be aware of, and you need to be prepared for, because you don't want to get this loan and say, hey, I thought I had $50,000, where is it? Well, it's not here today, right?
And the most common question I get on the Purchase Plus is people do feel, or they don't realize that they actually have to do the work.
Yeah.
And that's very common in most of these. And yeah, I mean, you sum that up very well. So.
Well, you know what? Hey, just want to say thank you again, Stu. You've taken a lot of time with us here, and you provide some great, valuable information. I hope our viewers got informed, and more than anything, became a little bit more expert yourself. So whether you're buying or selling, you kind of understand the process a little bit better, what you need to be prepared for, the kind of questions you need to ask. And because there's always 2 goals we have in mind: to make this process as absolutely smooth as possible and to save you money. So thank you for watching. Again, Luke McLaren with the McLaren Real Estate Team, Stu Douglas, mortgage specialist with Scotiabank. Eric's behind the camera doing a great job as always, and we'll look forward to next time. Bye for now.